Waking up on the first of every month and reaching for your checkbook to write out another rent payment can be financially draining. But what if you have a magic wand to pay off those rents? What if you don't have to work for it? It may sound too good to be true, but it's not. You just have to know what you're investing in. In this video, we'll show you 6 of the best covered call ETFs, including ETNs that follow these ETFs. We will show you and John how much you can earn in dividends with an investment of $10,000 for 10, 20, and 30 years. We'll show you a fund that you can turn your $10,000 investment into millions. And in the end, we will show you a portfolio of these funds to generate consistent and risk-free earnings for the rest of your life. But first, before showing you the 6 buy and hold forever covered call ETFs, what are covered call ETFs and how do they work? A covered call is like a special deal in the stock market. Imagine you have some shares and you make a deal with someone. You say, if you want to buy my shares at a certain price before this date, I'll sell them to you. If they don't want to buy, you get some extra money for making the deal. This extra money is called premiums. People do this to earn more, but knowing the right price and time is tricky. That's where the funds called ETFs come in. ETFs manage the hard part of using this strategy to perfection. You just buy these funds, and the people who manage them make the deals. It's an easier way to make money from the stock market without worrying too much. Now that you know what covered call ETFs are, let's see John's list of the top 6 buy and hold forever covered call ETFs arranged from modest to some of the highest dividend yields. Starting at number 6, we have Global X S&P 500 covered call ETF. Known by the ticker symbol XYLD, it is one of the popular investment choices mainly because this ETF pays dividends every month. Currently, it has a dividend yield of 9.37%, and it has been consistently paying a dividend yield around this mark. Based on this, if John invests $10,000 in this ETF, holds it, and reinvests his dividends, his investment in 10 years will be worth $25,430, paying him an annual dividend of $2,266. In 20 years, the same investment will be worth $64,671, paying an annual dividend of $5,763. And it gets better from here. In 30 years, John's initial investment of $10,000 will be worth $164,460, paying him an annual dividend of $14,655, or roughly $1,221 per month. XYLD, similar to its brother ETF QYLD, focuses on the S&P 500 for income. Interestingly, XYLD has held up better than similar funds. Last year, when major indexes like the S&P 500 and NASDAQ declined significantly, XYLD managed to preserve capital while generating double-digit yields. Its strategy involves buying S&P 500 stocks and selling call options, ensuring monthly income beyond dividends. Remarkably, XYLD has paid monthly since its 2013 inception, appealing to those building future income streams. Next, at number 5, we have Global X NASDAQ 100 Covered Call ETF. Known by the ticker symbol QYLD, this fund promises investors to potentially earn dividends every month while reducing some of the risks that come with investing in a big American stock index. Right off the bat, it offers a hefty monthly dividend yield of 9.84%, which is way higher than inflation and beats other common investments like the S&P 500. Based on that yield, if John invests $10,000 in this ETF and holds onto it, in 10 years his investment will grow to $26,644, paying out an annual dividend of $2,487. Fast forward 20 years, and that same investment will grow to an impressive $70,991, delivering an annual dividend of $6,627. And in 30 years, John's initial $10,000 could balloon to $189,151, paying him an annual dividend of $17,657, or around $1,471 per month. Here's how it works. QYLD invests in NASDAQ 100 tech giants using a covered call strategy. It sells short-term options to generate extra income for its shareholders. As for the holdings, this fund mainly invests in big tech companies such as Microsoft and Apple. These tech giants make up a big chunk of its holdings. One thing that makes this fund stand out is its SMART score of 8 out of 10, indicating it's a good pick among investors. As for the price target, Wall Street experts think it could go up about 13% from where it is now. Next on the list is JP Morgan Equity Premium Income ETF. Known by the ticker symbol JEPI, this fund has become a significant player in the dividend ETF world, growing to a hefty $25 billion in assets in just under 3 years. In fact, it's the third largest ETF in terms of net inflows this year, which ultimately translates to its yearly dividend yield of 10.03%. Based on this, if John invests $10,000 in this ETF and holds it, after 10 years his investment will grow to $27,151, giving him an annual dividend of $2,581. In 20 years, that same investment will grow to $73,718, paying an annual dividend of $7,007. And in 30 years, John's initial $10,000 will be a remarkable $200,152, offering him an annual dividend of $19,026, or roughly $1,585 every month. JEPI takes a unique approach by blending undervalued low-risk S&P 500 stocks with equity-linked notes, a form of covered call strategy on the S&P 500. This combo creates an ETF focused on large-cap equities with an emphasis on value and stability, aiming for impressive yields. What stands out is JEPI's consistently high yield, often topping 10%. It has a track record of matching S&P 500 returns but with lower risk, making it appealing for both long-term investors and income seekers. Notably, JEPI provides monthly distributions, not quarterly, and charges a reasonable 0.35% expense ratio considering its unique strategy. Next, we have the sibling of JEPI, JP Morgan NASDAQ Equity Premium Income ETF. Known by the ticker symbol JEPQ, this sibling also has an attractive dividend yield of 11.5%. With JEPQ, if John invests $10,000 and holds onto it, the numbers look even better than its sibling. In 10 years, his $10,000 investment will grow to $31,409 with an annual dividend of $3,397. Fast forward 20 years, and that investment will be valued at $98,655, paying an annual dividend of $10,669. And in 30 years, John's initial $10,000 will grow to $309,871, delivering an annual dividend of $33,511. That's around $2,792 every month. So how does JEPQ work? It's kind of like JEPI, but with a tech twist. It focuses on large-cap U.S. growth stocks in the tech sector. It's a relatively new kid on the block, launching in 2022, and it currently manages $1.75 billion in assets. Still, it pays dividends monthly. The fund focuses on large-cap U.S. growth stocks in the tech realm. And here's the kicker, it doesn't play by the rules of typical ETFs. To score that high yield, it allocates up to 20% of its assets to something called equity-linked notes, in short, ELNs, and dabbles in option selling on stocks. This helps generate monthly income and reduce wild price swings. Next on the list is Credit Suisse X-Links Gold Shares Covered Call ETN. Known by the ticker symbol GLDI, this is a covered call ETN that tracks GLD ETF. It's a bit fancy and works like this. It tracks the GLD ETF, which holds actual gold. But here's the twist, it sells covered calls on that gold to give investors regular dividends. So what does this mean? GLD keeps real gold in line with the money it manages, and GLDI tags along, but it does something extra. Each month, it sells an option on the gold to secure the profit's potential gains. Think of it like a ceiling on how much money it can make in a month, and that's before counting the dividends. This strategy is why GLDI hasn't done as well as GLD during a strong year for gold. When gold prices shoot up, GLDI doesn't ride that wave as high because it's like putting a cap on how much it can earn. Based on this, if John invests $10,000 in this ETF, holds it, and reinvests his dividends, his investment in 10 years will be worth $39,088, paying him an annual dividend of $4,981. In 20 years, the same investment will be worth $152,786, paying an annual dividend of $19,470. And it gets better from here. In 30 years, John's initial investment of $10,000 will be worth $597,209, paying him an annual dividend of $76,108, or roughly $6,342 per month. Next, John's final long-term investment pick before creating a portfolio is Credit Suisse X-Link's crude oil shares covered call ETNs. Known by the ticker symbol USOI, this investment has caught some attention lately with a 23.02% return this year, along with a juicy 27.38% dividend yield. Before showing what John would earn from this yield, first let's see what this fund is all about. Also, after this fund, we'll make these investments safer by using a portfolio of all these ETFs to still earn a decent monthly income. Back to USOI. This ETN offers a unique way to tap into the crude oil market. It mirrors the performance of the USO ETF, but with a twist. USOI sells call options on USO, about 6% above its current price each month, trading some potential gains for a nice dividend yield. While USO's monthly futures contract rolling can eat into the profits when oil prices rise, here's the good news. USOI isn't too bothered by this right now. That's because the way it's set up, it's not facing the same issue as USO at the moment. Now let's see how much John can earn from this fund. Based on that yield, if John invests $10,000 in this ETF and holds onto it, in 10 years, his investment will grow to $112,464, paying out an annual dividend of $24,174. Fast forward 20 years, and that same investment will grow to an astounding $1,264,809, paying an annual dividend of $271,867. It seems unrealistic, but that's what buy and hold forever ETFs can do. In 30 years, John's initial $10,000 investment, with a 27.28% yield, could balloon to $14,224,511, paying him an annual dividend of $3,057,521, or around $254,793 every month. Though that number may seem very tempting, there are some issues with some of these high-yield funds. They're not usually consistent. So to make the most of it, one of the go-to strategies of seasoned investors is to make a portfolio of all these ETFs. We know XYLD pays a dividend yield of 9.37%. QYLD has 9.84%, JEPI with 10.03%, JEPQ with 11.5%, GLDI with a solid 13.71%, and lastly USOI with a very high but uncertain dividend yield of 27.38%. If we total up all 6 yields, then divide it by 6, which is the number of ETFs we hold, we get an average portfolio dividend yield of 13.63%. Based on this, if John invests $10,000 in this portfolio and holds it, after 10 years his investment will grow to $31,816, paying him an annual dividend of $3,477. In 20 years, that same investment will grow to $101,229, paying an annual dividend of $11,063. And in 30 years, John's initial $10,000 will be a remarkable $322,076, offering him an annual dividend of $35,200 or roughly $2,933 every month. Though not in millions, this number is more realistic and consistent with the portfolio. In this video, we discussed the top 6 covered call ETFs to buy and hold forever, but maybe you prefer investing in stocks. For this, watch our video on 10 buy and hold forever dividend stocks, where you'll learn strategies to earn over $20,000 monthly.